Okay, moving to options. The first chapter we're gonna cover is mechanics of options markets. So mainly, as you all know, an option is an instrument that gives you the right but not the obligation to do something, whether to buy when we talk about a call option or to sell something when we talk about a put option. So you have the right to either buy the call or sell, to buy the underlying asset or sell it at a certain date and for a predetermined price. And mainly the key characteristic of calls and puts is that the holder of the option can choose not to use the option. And this mainly gives always an advantage to the party with the long position. Because in this case, if you are hedging, let's say, if you are hedging against the increase in the price of the underlying asset, and you take a long position in the call, in this case, this call option guarantees that you are not affected by any significant increase in the price of the underlying asset. However, if the price of the underlying asset decreases, you don't have to use your call option. You do not have an obligation to buy at that predetermined price. So let's say that you have X, which is the strike price, is equal to 100. In this case, if the price in the market P1 was, let's say, 120, in this case, you can exercise your right and buy it at 100. However, if the price was $80, you do not have an obligation to buy at 100. So simply you decide not to exercise your option, and you can buy that asset at the market price of $80 per share if it's in stock or if it's a different underlying. So you can still benefit from any decrease in the price. However, you are protected against any increase in the price of the underlying asset. And this is mainly an advantage of options over futures. Later on, we're gonna discuss the major differences between the two futures versus options. Now, the main options positions are the following: long call, and with a long call, mainly you have the right to buy. With the long put, you have the right to sell. Now, the party with the short position, if I start with the short call, the party with the short call is the counterparty for the one with the long call. So if the party with the long call has the right to buy, this means that the party with the short call has an obligation to sell if the party with the long call decides to buy. Now, when I move to the short put, the short put has an obligation to buy if the party with the long position decides to sell. So as you can see, mainly there's an advantage for the parties with the long position. So whether you have a long call or a long put, you have an advantage over the party with the short position, because you will only exercise if it's profitable to exercise your option. If you will end up losing money, you will decide simply not to exercise. So for that reason, the party with the short position who has a disadvantage relative to the long position will require a premium or a price for that option. So mainly, like once we enter into such a position, the party with the long position should pay a premium to the party with the short position. And later on in the future, there may be some cash flows from the party with the short position to the party with the long position if it's profitable to exercise. If not, there won't be any further cash flows between those two parties, and the short seller in this case will end up picking up the premium for that option. Okay, now some terminology that we're gonna use, mainly as I've talked before about the strike price or the exercise price, and mainly in some books it's either K or X. Like mainly we're gonna use both terms throughout this semester. So the strike price is the price at which you have the right to buy if it's a call, or the price at which you have the right to sell if it's a put option. Now, exercising the option means that the party with the long position, let's say we're talking about a call, the party with the long position will buy the underlying asset at the exercise price. However, usually, like how options work, let me here give a quick example. So let's say, for example, that you take a long call position, each on stock options. So in this case, each one covers 100 shares. Each contract covers 100 shares, and here you have long one call option covering 100 shares. Let's say that the strike price X is $1,000. So you have the right to buy the shares at $1,000 each. Let's say that the price increases to, for example, $11.50. In this case, when you exercise the option, you buy at $1,000 per share. So if you want to buy those 100 shares, you need to pay $100,000. But what will happen is that once you exercise, it's like two events will happen simultaneously. It's like you are buying at $1,000 per share, and at the same time you are selling those same 100 shares. You sell them at $11.50. In this case, you will be receiving $115,000, and you will be making a profit of $15,000. So mainly, you do not need that amount of money to be in your account. You don't need to have $100,000 in cash in your account so you can buy the shares and then sell them. Because it's like those two transactions, it's like they are happening simultaneously at the same time. So what you will see that once you exercise this option, you will end up with $15,000 of profit in your account. Now, the expiration date is the date by which the option must be either exercised or it becomes worthless. And we will denote this by capital T. So mainly each option will have, let's say, the expiry date is after 6 months from today, so August, let's say 23rd, 2021. This is the expiry date of the option. So from now till that date, for example, you have the right to buy at $50 per share. So here we are talking about a call option. So let's say that over this period of time, the price remains below $50 per share. In this case, once you reach this date, your option will become worthless, and we will say that it will expire out of the money. Now, in case the price on August 23rd was higher than 50, you will exercise your right and buy that stock at $50 per share in order to get the profit, which is the difference between those two prices. The actual price, the current price of the stock versus the strike price of the option. Now, regarding the exercise style, here we can differentiate between two major types of options. We have European options and American options. Now, a European option can only be exercised at the end of its life. This means at the expiration date. So if this is first European option, let's say that August 23rd, this is the expiry date. This means that you have the right to buy at 50 only on that date. You do not have the right to exercise before that date. However, with the American option, you can exercise at any point in time between now and the expiry date of the option. So you can exercise here on August 23rd or at any point in time prior to that date. And here, the naming has nothing to do with the geographical location. So it doesn't mean that in Europe, mainly options are European, and in the US, all options are American options. Mainly, most of the traded options are American options, with some exceptions. So mainly foreign currency options and stock index options can be European or American. Like for stocks, they are mainly American options. The options on the S&P 500, like the SP 500, is mainly a European option, while the SP 100, which is an option on the S&P 100, is an American option. So you have a mix. There's no rule on whether which options are American or European. Usually those are like determined by the exchange, whether they are, excuse me, American or European. And now I'm gonna talk about some types of exotic options. So mainly, like throughout the semester, we will be talking about American and European options. However, we're gonna talk like about other exotic options. So for example, you have Asian options. Also, it has nothing to do with the geographical location, so those are not like those that are traded in Asian markets. So an Asian option is an option where the payoff depends on the average price of the underlying asset over a certain period of time. So mainly with the American or with the European, you have the right to buy at X. So this is with the European or the American. Now with the Asian option, it's like the price at which you have the right to buy is not predetermined. It's like it's more based on the average price over a certain period of time. Now another type of exotic options is the Bermudan option, which can be exercised at expiration date and on certain specified dates between the purchase date and the expiration date. So it's like in between the European and the American option. So for example, if I go back to that example, August 23rd, 2021. So mainly here you have the right to exercise here at expiry, and you have, let's say, the right to exercise on, for example, July 17, and let's say on May 5, for example. So in addition to the right to exercise on the expiry date, you have also the right to exercise on specific dates between time t equals 0 and the expiry date. Other types include binary options. So with those options, it's like you are getting either 0 or 1. It's either you don't get anything or you will get the full payoff. So with those options, the final payouts increase incrementally with each rise in the underlying asset's price above the strike. And this option provides the buyer with the predetermined lump sum at that point and beyond. So for example, if the strike price X is equal to 50, for example, and the price, if the price P1 is below 50, you will get 0. You will get nothing. However, if the price increases above 50, you will end up receiving this determined lump sum. It may be $100, $500, whatever. So here you are receiving the full lump sum. Whether the price is 51, 55, or 60, or 100, whatever, you will get the same lump sum if the price is above the strike price by the expiry date or before the expiry date. Okay, now I will go further to talk in details about how the American mainly call options and American put options operate. So mainly when I'm talking about a call option on stock, each call option mainly covers 100 shares. So an American call option is in this case a contract giving the owner the right to buy 100 shares at a price X at any time prior to maturity T. And mainly, the call is not an obligation to buy those 100 shares. So the owner of the call option will only exercise if the price, I will call the price ST, is greater than or equal to X. So for example, if you have the right to buy at 75 and the price is 82, in this case, you will exercise your option and you will be able to buy at 75 and sell at 82. If the price in the market is below 75, simply you will decide not to exercise and your option is gonna expire worthless. Now, for each long position, there's a short position, because remember, this is a contract between two parties. So here, the party with the long position have the right to buy. The party with the short position will have the obligation to sell. So now, mainly at time t equals 0, the party with the long position will pay the premium to the party with the short position. Now, if in the future, if there's an exercise, this means that the party with the long position will have a positive cash flow, and the party with the short position will have a cash outflow or a negative cash flow. In case there's no exercise, there's no cash flows between those two parties. So as you can see from this contract, we can say that this is a zero-sum game, as is the case for all derivatives contracts. So in this case, if the party with the long position ends up with a profit, let's say, of 250, this means that the short position is gonna lose $250. And this is assuming that there are no commissions or transaction costs. So the profit for one party is equivalent to the loss of the other party of that same contract. Now, with an American put option, the party with the long position will have the right to sell 100 shares at a price X at any time prior to the expiry date. And in this case, the party with the short position will have an obligation to buy if the party with the long position decides to exercise. Now, mainly puts and calls on individual stocks or on indices, they are actively traded on the CBOE and the International Securities Exchange, which is an electronic market based in New York. However, the major one is the Chicago Board Options Exchange, CBOE, which is based in Chicago. And options trading mainly dates back to the 17th century, where farmers in Holland used to buy put options on tulip bulbs to reduce the price uncertainty. So as we're gonna see later on, like a put option mainly operates like an insurance. So mainly when you buy an insurance, you do not intend to make a profit from the insurance, but just to protect yourself against any adverse event in the future. So in this case, that adverse event is that the price of tulip bulbs goes down in the future, affecting farmers. So for those farmers, they were buying an insurance through buying those over-the-counter put options. And mainly before 1973, all trading in options was in over-the-counter markets. The first standardized options were introduced in 1973. So the first standardized call options, they started to trade on the Chicago Board Options Exchange in 1973. Now, at that point in time, we had only call options because regulators, they were afraid that if put options were introduced to the market, that some traders, because they're gonna profit if stock prices decrease. So they may have a motivation to manipulate the market in a way to depress prices, to lead prices to go down. So mainly regulators, they were afraid that introducing put options is gonna cause, troubles in the stock market. So at the beginning, only call options were traded. However, as we're gonna discover later on, is that even if put options weren't allowed, still investors, they were able to create their own put options, what we call a synthetic put options. This is something we'll see later on. And later on, the regulators, they did see that those investors who were replicating those put options, they were not affecting the market in a negative way. So at a later point in time, put options were also introduced to the exchanges, and investors started trading those standardized put options. Now, mainly without a centralized agency to guarantee payment in the event of exercise, it's hard to trade option contracts because of solvency issues. So let's say if I go back here and provide an example for an over-the-counter option. So let's say in this case, one party takes a long position on a call to buy, let's say, 100 shares of A, I will call it company A or stock A, at X equals $50. Let's assume that the price at expiry was $120, and this party decides to exercise. This means that it's like this party is gonna buy from the party with the short position. So it's like they're gonna pay 50 times 100. So they're gonna pay $50,000 and then simultaneously sell those shares back to the party with the short position for a price of $120 per share. So here you have 120,000. So as a result, they're gonna be a net cash inflow of $70,000 from the party with the short position to the party with the long position. However, in this case, the party with the short position may not have enough money to cover that loss of $70,000. So that's why there's risk in over-the-counter options, and mainly most of the traded options, they are traded through an exchange. And I hope, let's say later on, all of you will be able to take short positions in a call, and specifically something called an uncovered call. So to short a call where you don't have any position in the underlying asset. So this is one of the most risky transactions that you can ever take, and usually your broker won't allow you to take a short position on a call unless, let's say, your account is in millions of dollars. So only large investors and institutional investors, they can take a short position on a call when they do not own the underlying asset, what's called shorting an uncovered call. We will talk more about those cases once we cover options strategies. So now with the exchange, there's more guarantee, because mainly there's a margin requirement for taking a short position on whether a call or a put. And as I said, unless you have significant amounts in your account, brokers won't allow you to take such short positions. So now, the role of the option clearing corporation, which is part of the exchange, and it's mainly owned by the exchange, is to solve the solvency problem by placing itself between two traders. So in this case, it becomes the effective buyer of the option from the writer and the effective writer to the buyer. So in this case, it's like the default risk or the counterparty risk is eliminated. And in this case, when I talk about the risk of default, like for over-the-counter options, the risk of default is only on the part of the buyer of the option, the party with the long position. Because remember, between the party with the long position and the party with the short position, at initiation, there's a cash flow from the long position to the short position. In the future, if there's any cash flow, it will go in the other way. So in this case, the party with the short position doesn't have a counterparty risk, doesn't have a risk that the party with the long position doesn't have enough money, because there is no other cash flow from the party with the long position to that with the short position. This is the only direction of any future cash flow, if there's such a cash flow. So mainly the risk, the counterparty risk, is on the part of the party with the long position. So through those exchange traded options, it's like we can eliminate the default or the counterparty risk. And in this case, this is the party with the long position, this is the party with the short position. So mainly you have the options clearing house in between. So when the option is sold, it's like the clearing house buys the option from the seller and it sells it to the buyer or to the party with the long position. Okay, so mainly we've talked about the expiration date of an option. Mainly like for most stock options on exchanges, they have like options with a short expiry date of 6 months or less. However, we have something called LEAPS, the long-term equity anticipation securities, which could have expiration periods of up to 3 years. And mainly because based on the demand on such contracts in the market, you may have additional expiry dates introduced, let's say up to 3 years. If there's a demand, let's say for up to 4 years, you will see that such instruments are created, and you can see, let's say, a call or a put option with an expiry, let's say, of 4 years or 3 years. So mainly with each option traded on exchange, that option will have a predetermined expiration date that's set by the exchange. In addition to that, they will set, so this is the expiry date, they will also set the strike price of the option, and whether that option is European or American, and finally what's the option class, whether it's a call option or a put option. So those are the specifications of the exchange traded options. So now, to compare quickly between options versus futures and forwards. A futures or a forward contract gives the holder the obligation to buy or sell at a certain price or at a predetermined price, while the option gives the holder the right to buy or sell at a certain price. Now, the advantage of options in this case is that with options, if I'm talking, let's say, about a long position in a call, so I'm comparing mainly between a long call and a long futures contract. Now, with both positions, you are protecting yourself, or you are benefiting through that contract from any increase in the value of the underlying asset. However, in the case of the long futures, if the price movement is that there's a decrease in the price, which is beneficial for a hedger, let's say. So if someone is hedging, or if someone wants to buy the asset in the future, so if you want to buy the asset in the future, let's say that whether you are using the call or the futures contract, you are able to buy at, for example, 100,000. Now, whatever happens to the price in the market, whether you have the call or the futures, you will be able to buy at $100,000. So if the price is 120,000, you can buy at 100,000. However, if the price is, let's say, $70,000, with the futures contract, you still have the obligation to buy at $100,000. With the long call, you will leave the call expiring out of the money, and you can buy at the $70,000 at lower price. So with the options, you can benefit in the case of a long call, and if you want, let's say you did buy that call just for hedging, you can still buy at that lower price, which is not available through the futures contract. Now, the disadvantage of options is that for options, you need to pay a premium. So at time t equals 0, there's a cash outflow. While for the futures, there's no cash outflow. Like you do not pay anything as the price of that future contract. So the money that you put in the margin account is still your own money. So this is mainly the disadvantage for options, the premium. The advantage is that you can still benefit, if I'm talking about the call, and you were hedging if the price decreases. Now, of course, if you were speculating, if you did buy the call options because you are expecting the price to increase in the future, you will end up losing money. You'll end up losing money. You'll end up losing the premium of your option if the price of the stock goes down.